Welcome back to Why Commodities with James Cordier. Hello, I'm Joe Pardavila. And James, how are you today?
We're doing well here in Tampa, Joe. Thank you very much. How about you?
I'm doing well, and obviously you're in Tampa and wearing a sweater, so it's below 80 degrees. So thoughts and prayers to you and your
Yeah,
family down there in Florida.
it was in the 50s this morning and very windy, and wound up with a sweater on today.
I'm going to light a candle for you later, James. So today we are going to get into corn and cattle, a subject that we have not touched upon too in depth on this podcast so far. And we have a true cow expert. But before we get there, James, let's talk broad strokes. Corn and cattle. What are we talking about these days?
You know, I've been trading cattle on and off for the last 3 decades. Last time I was really getting involved in cattle trading, we were trading hands at around 65 cents a pound. And I know Scott is going to talk about this in a little bit, but I'm pretty sure we hit an all-time record high just not that long ago, a couple months ago. And the price of cattle have tripled in value. The cattle herd is very small, and it'll be really interesting today to hear some of Scott's ideas on how we're going to make a larger cattle herd with, 3 times the people eating beef than there were 50 years ago, and yet the cattle herd's at a 50-year low. It's going to be really interesting to see how there's an expansion in cattle production. And of course, bushels of corn make a cow weigh 1,350 pounds or something like that. And corn and cattle is very near and dear to a lot of people's hearts. If you enjoy a Fleming Steakhouse or anywhere else, Smith and Walensky, it's a really important topic. And we trade cattle, and we trade corn. And this can touch a lot of different ideas right now, as far as the consumer going out for a steak or people trading like Scott and I.
Awesome. And the Scott you speak of is no other than Scott Shellady, the cow guy. Scott, how are you, sir?
I'm great. Thank you very much for having me on. I really enjoy it. And what better than me to talk about cattle, right? I mean, it's near and dear to my heart, especially corn. We have a family farm, so I'm ready.
All right. So before we get into the nitty gritty, Scott, I'd love to find out because if someone were to read up on you, they would think you're an international spy because you're in the States cutting your teeth on corn and cattle, then somehow end up in Europe for a couple of decades and then come back in a blaze of glory. Can you just break down that journey for us? Because it is pretty fascinating.
Yeah, we're real quick. My father was in the business. He started with Cargill in 1962. I came around and got in the business in 1988. My father was very well known in Chicago. We were very, very close, but as you can imagine, I didn't want to have anything to do with him. I didn't want to have the coattails thing on my, I wanted to make my own way. And I got offered I did pretty well out of college trading. And so I got made a partner in our firm. And at the age of 24, they sent me to open up our office in London. So 16 years later, when I finally came back from London, I had made my own money. I had made my own way. And my father was on the way out of the business. And I thought it'd be nice to kind of wear his trading jacket as an on homage to my father. We were very, very close. And the jacket he wore was a cow jacket because we had a dairy farm. We milked 200 head of cattle twice a day. We also had 800 acres of corn and beans. And so he loved that part of it, but he was there. About the time I came back from London, there was a ton of money that came into our business, and with money comes media. So when my father retired, I wore the jacket, I got the attention, and I kind of accidentally I'm an accidental commentator. I'm a good trader, but I was also pretty good at talking about the markets too. So then it went off in my brain, maybe as I got older, that'd be a great way to segue into something I could do and extend my career rather than go down there and fight with my elbows and what else every day to try to make some money. And so that's what I did. And so I was in London for 16 years, traded on the life floor there. I actually ran the Industrial Bank of Japan over there. I was probably a level 9 director at Deutsche Bank. My specialty was options, but I cut my teeth in stocks and bonds in Europe. I was more ags here in the States because of our farm and my father. And all of a sudden, by the mid 2000s, maybe late 2008, 2009, all of a sudden I was the cow guy. And I had done a few spots before, but it really blew up. And so I've been probably doing it for 25 years now, but of which the last 20 it's been pretty crazy. And now, towards the end of my career, I'm 59 years old. I got an offer 4 years ago to actually have my own show called The Cow Guy Close and come down here to Nashville, get my own air coast to coast live. And we're the number one show on RFT TV's air here, a number one live show. And we've got we pull in some pretty good numbers. And what I do is, you've got all of your Fox Newses and you've got your CNBCs, you've got your Newsmaxes out there. But I told the owners of this station that I didn't want to be like a financial commentator like they have now. What I wanted to do was talk to what I thought was, and I actually think that I could probably prove it, but I think that middle America, agricultural America, ranching America, because of what's been happening with inflation, they are the wealthiest, most underserved investing class in America. And you don't know how many farmers out there that own 3,000 acres of land that is worth 20 grand an acre. I mean, they have so much money and nobody talks to them. And so I have a little sway because I can walk the walk and talk the talk. So I told the owners of this firm, I said, you know what I want to do? I want to talk to farmers and ranchers about making money with the money they make from farming and ranching, but I don't want to talk to them about farming and ranching. They should know how to do that. And they went for it. And it's turned out to be a fantastic recipe because I run my show like a lot of the other financial shows. I have great commentators come on. We talk a lot about stocks, a lot about bonds, a lot about commodities. I'm very, very proud of it. It's been 3 years. I've got about 850 shows in the can. And it's only a half hour long. I think we're gonna make it an hour long. Coming up here shortly, and we'll see what goes from there. But it's been a wild ride, and nothing I ever could have planned. It's nothing I could ever talk to any business school student about. It's just the accidental commentator, and here we are.
That's amazing. And you have probably your number one fanboy joining here in James Cordier. James, what is it that Scott the Cow Guy does that's so impactful in this part of your commodities world? Because I'm sure there's a lot of people that are doing similar type stuff, but just not delivering it in the same way as the Cow Guy.
Two things about that, Joe. One thing that's quite interesting. I was in the corn pit visiting our broker about 25 years ago. And he goes, "Oh, James, there's the Cow Guy." This is 25 years ago. He said, "Keep an eye on him. He's going to be doing this for a very long time, and he's going to be really special." And this is like one of the biggest corn brokers in the corn pit. And Scott, you know how big the corn pit was. It was huge. There's a lot of trading volume going on. He said, "You watch this guy. There he is right over there." And I saw a glimpse of you. It's like Batman. It's like so cool. As far as Scott's show, there's very few shows like this. If you watch CNBC or Bloomberg or Fox or what have you, I've been on those shows a number of times. And if you're looking for commodity news or commodity analysis and how to invest in it, it's really sparse. For example, on the CNBCs of the world, they'll talk to someone about Apple for 25 minutes. And they just spoke to someone 2 days ago about Apple for 30 minutes. But they'll have me to come on and talk about the price of coffee. I'll say 3 sentences, and about 45 seconds later, that's all we have for today. So commodities and the analysis on, like, for example, Scott's show, for myself and a lot of our commodity traders is priceless. We trade fundamentally. We don't trade algorithms. We're not trading in and out 4 times a day. We're making 3-month, 6-month, 9-month analysis. And that's the same type of information that Scott delivers to his viewers. And that's why we think the show is so great.
Well, Scott, I saw you nodding there, so it sounds like James is singing your song here.
Yeah, well, I wanted to, and I wanted to add to that is that, this is my 38th year. I ran the largest Japanese bank in London for 5 years. I worked at Deutsche Bank for 4 years. And I also spent a large part of my career in Asia, working for the Deutsche Bank in Japan. And I got to sit in all those dealing rooms. I'm sure you guys have seen the football fields of dealing rooms that say Deutsche Bank and, Goldman Sachs and Credit Suisse have, right? You've been on those floors. But as I got older and moved through the system, I noticed a few things, and there's really only 3 things we can trade in this world. There are thousands, if not hundreds of thousands of derivatives off of these three things, but you basically can trade commodities, anything mercantile-ish, anything that's interest rate based that goes from bonds to currencies, and then obviously stocks, okay? And then anything off of those, the options, everything goes off those. So it's commodities, interest rates, and stocks. And so on those trading floors, whether it may be Tokyo, whether it may be Frankfurt, London, or New York, the guys that ran the equity desk, like you just said, they talk about Apple one day, 30 minutes, the next day, 20 minutes. The reason why they do that is there's so many people out there that trade Apple, right? It's got a huge customer base, and also it's a huge stock with a lot of money involved. So if you're on the equity desk of some of these big institutions like Deutsche Bank or Industrial Bank of Japan, like I was, you have budgets that you have to hit, right? So you try to make $50 million worth of the 20 guys on your equities desk have a budget to try to make $50 million with the amount of money that the bank gives them as capital. And if they hit that, they get a big bonus. Each guy gets a big bonus. And the equity desk had the biggest budget because they had the biggest, the most people that were trading equities. I mean, it was the biggest basket. And then I went down to the interest rate guys, and it was similar there, but maybe they only had a budget of 25 million or 20 million. But then I went down to the last guys, which were always the commodities guys. And as I got older, and because we had a family farm and my father worked for Cargill, I started to see something which I thought was really interesting. Just because there's a lot more people trading stocks and a lot more money in stocks, I mean, come on. You could buy the entire corn crop with the money that Apple's got in his bank right now. Okay? That's the problem, right? They have just a much bigger scope. But you know what? They're not better traders. They just had an opportunity to make more money because of the field they're playing on. And what used to irritate me was that's how it flowed. The guy on the equity desk was kind of an oik, not really that bright, but he had a bigger field to play on. Well, they hit their numbers, and that guy gets $1 million bonus. All right, then it goes down to the interest rate desk, right? They're trading bonds, they're trading currencies, whatever they're doing, and they hit their numbers, and that guy gets a $700,000 bonus or a $500,000 bonus. But when it comes to the smaller commodity desk, where they don't have the scope, those guys are better traders because they have to deal with Mother Nature. You don't have to deal with Mother Nature when the equity guys, the interest rate guys don't either. And so the guys that have the hardest thing to do and deal with Mother Nature, if they hit their numbers, they got a brand new pickup full of fertilizer. And it used to make me angry because they're better traders because they have to trade so many more unknowns, but nobody knew because they didn't put up the big numbers like the other two desks did. So when I came here to RFT TV in Nashville, I just kind of felt like that side of the business deserved to be in the limelight a little bit. And then I got lucky, as one does. You have to have a little bit of luck every now and again. Inflation made those people that were going to be watching the show 5 times wealthier than they ever thought they could be within a couple-year period. And now they got the money, and now they want to do something with it. And here I am.
What's so interesting, Scott, about talking about equities versus commodities, one thing that I'm really interested in commodities is because whether the economy is doing great and the stock market's doing great, that doesn't affect you and I trading commodities. Whether the economy's flatlining and the stock market's going sideways does not affect us trading commodities. And most importantly, when the stock market is in correction mode and the economy is weakening, that doesn't affect our investment either. And that's why the alternative investment, being commodities, is really starting to catch on right now with all the cash flow that's flying around in Florida and everywhere else. Commodities are becoming much more interesting to the mainstream, to the point where no one would ever consider trading crude oil or gold or options on these things. And now they are. And that's quite a nice bright spot right now.
I get in a little trouble when I say this when I go speaking. I do a lot of speaking because there's only so much money this place can pay me, so I have to find another way to make it. But I wish I was an equity guy. I mean, equity guys can forget their portfolio in the bottom drawer, go away for 20 years to pull a Rip Van Winkle, come back, and it's higher. I mean, because equities just only go from the lower left to the upper right. Bonds don't do that. And so for sure, corn and beans and coffee don't do that. You have to really babysit that stuff. So if I'm an equity guy, they always get mad at me when I say this. I'm like, that's got to be the easiest job in the world. Hey, Shellady, the cow guy, what do you think about equities? Ah, they're going up. Buy them. That's all you got to say. You can't say that with corn, beans, wheat, coffee, sugar, cocoa. You can't. Yeah, you really can't even say that with interest rates because they don't act like equities do. But equities over time, as long as your population is getting bigger, i.e., you're inventing or you're making more new customers for your product, it's going to go up. Where else could you have a grandmother die that hasn't looked at her portfolio in 25 years and have it gone up by 5 times? If she's got a portfolio of corn or bonds, that ain't happening.
And Scott, to your point, trading commodities, you really have to pay attention and be watching all the time. The fundamentals are changing, and there's about 12 commodities to trade, as opposed to the stock market going from the bottom left to the top right.
Exactly right.
Well, let's move on to the beef. And before we do it, a random question for you, Scott. For years, and you've been in this game for so long, people have been saying, stop eating meat, eat chicken. They got into a lab and said, let's make this fake plant-based. All this going on the outside, yet beef is more popular than ever before. Can you explain its popularity to the masses? Because I'm telling you, for years they've been trying to make people stop eating it, but people just want more of it.
Well, there's a little bit of a political answer to the question but it's a virtue signal. We don't want to hurt the animal anymore. That's the left doesn't want to hurt animals. They want to treat them nicely. There's part of that they think that they're adding to climate change, right? With methane. There's that part in there, so they're going to virtue signal with fake meat at your restaurant. But at its core, you have to really step back and put your common sense hat on and go, boy, this is really dumb. I am not going out to Ruth's Chris to order fake meat. Nobody's going to do that. Is there a place on the American menu for fake meat? Yes, but it's going to be right next to non-alcoholic beer and decaf coffee.
That's awesome. That's awesome. All right.
Agreed.
James mentioned it earlier about the fact that all-time high for cattle prices, but the number of cattle herd are low. So tell me how this math works.
Probably a lot like the American fit physique. They're a lot bigger than they used to be. So they've made up for the lack of cattle with size. But we do have problems, and everybody's waiting for this replenishment of that herd because it's an all-time, 1940, I think, is whatever. I speak to a ton of guys about it. That number gets thrown around a little bit, but at the core here is this: we can't afford really to have another dry Western summer. Everybody's looking for this replenishment, and every little chart that looks like it's turning up to see that we're going to be starting to maybe make our way that way. It still will take 2 years, by the way, number one. But number two is it's going to be difficult for that to happen. It still really is. It's not going to be anything that's going to happen overnight. And I think if we can keep the jobs steady, it doesn't have to be a blowout year for jobs, great jobs. And if we can keep wages steady, it doesn't have to be a blowout year for wages. As long as wages and jobs are steady, the customer will spend. And as long as the customer spends, you and I both, I'm sure the three of us know the feeling when you go into a nice steak joint, you're wondering, where's the finance window? It's like, where's a mortgage broker? Because it's $100 for a decent piece of meat here in Nashville. But that will still be the case if the customer feels like they can afford it, and they'll be able to afford it if they feel like their job is safe and their wages are going up. So there's some more things that are in that equation that just record low number of cattle. What are people willing to spend? It's got a lot to do with the economy and how comfortable the consumer feels. Now, I have to say this: consumers getting a little nervous right now. There's a few consumer sentiment numbers that have come through as of late that don't look that great. And I'm not sure if that's just the tariffs and Trump or whatever, but I think at the end of this year, I could be wrong, but I'm going to tell you right now, guys, I think at the end of this year, you're going to find out this was going to be more of a year that Trump struggled with inflation rather than the economy struggled with tariffs.
That's an interesting point. There's so much going on right now during the taping of this, interview right now that is so many moving parts, but I think it's all negotiating. I don't think it's going to be long lasting. I think we're going to get things put in place that should have been put in place years ago. We're finally getting that done. And I think at the end of the year, we won't be discussing that anymore. And hopefully We have some really good results from the negotiating that's going on with Mexico, Canada, and China right now. I think it's going to turn out quite well, actually. We'll have to wait and see.
So, Scott, with all that you said, how does that affect the commodities market when it comes to cattle and corn? Is it just one of those things where James always preaches patience on this show, but like, is it just like we got to be patient?
Well, yeah, I mean, yes, you have to be patient. I mean, patience is a virtue. That's what they say, right? You're going to have to be patient, but because we have other things at play, not just our own markets. I mean, you don't have to have as much patience in equities. You don't have to have as much in interest rates, but you have to have some in commodities because of the very nature of the trade. So it takes a while to replenish that herd. I mean, that's going to take patience, but I'm telling you, if we get another dry summer out west, that's going to throw some sand in the gears in that trade. It's really going to do that. And I mean, I think the funds were smelling something like that. I think this tariff thing as of late is going to put a dent in that their thought process there. But corn is also showing that it could be kind of tight here. That's why I ultimately think that we're going to slowly but surely get through this tariff talk, and you're going to start to trade the fundamentals. And if we have a dry summer, everybody talks about that. Yes, we're probably going to kill the crop once, maybe twice this year. But, I get a ton of research because a ton of people want to be on my show all the time, right? So I get all this free research, which is great. And I've turned in more of a lawyer than a trader because I read all the time. I don't have my wife can't stand me. All I do is read. But I'll tell you, the smart people that I follow, and they're looking at 900 years of sunspots and water temperatures and La Nina, El Nino. I mean, they're very concerned about a dry summer this year, and they have all of their indicators are lining up. When normally, if they have 5 indicators, 2 of them line up, they've got 4 out of 5 or 5 out of 5 lining up. This could be something that really dwarfs this whole tariff talk. That's because if you're gonna have to buy it. If you don't have it, you got to eat, right? I don't care what tariffs are, you got to eat. And if that's the case, I just think that we're way too bearish. The world's way too angry. And it's coming through in prices right now. And people are having to sell stuff because they need to get out. But I think that corn and cattle, just be patient. And I think the trade comes to you. Yeah.
I think commodities in general, coffee prices hit all-time highs this past year. Cocoa prices hit all-time record highs. The price of gold is at $3,000 an ounce, or it's been flirting with that. It's a raw goods industry going on right now. I think a lot of the money is pouring into commodities. Basically, whether it's some of the grains, which are kind of depressed right now, but some of the metals and the soft commodities are doing extremely well. The price of oil right now is also, I think, falling off recently because some of the tariff talk and because it has slowed down some demand. I saw jet fuel supplies in the United States were all-time record highs for this time of the year. The fact of the matter is populations are growing. The amount of commodities is not growing. It's smaller, just like the cattle market is. 50-year record lows for supplies. Commodities, I think, are going to do quite well this year. We have driving season coming up in another month or two, and the price of oil is probably going to get a bottom under it here as well. It may not, and it may keep going down. That doesn't mean there's guaranteed profits to be had, but commodities, I think, are going to have a really good 2025.
So yeah, I mean, it's hard. I can't argue with that. I mean, 2 things I would say is, I don't know, Jim Rogers, right? I mean,
Sure.
I keep going back to what he says. He still believes that, farmers are going to be the guys driving the Lamborghinis and the guys on Wall Street are going to be the guys, in an Uber. And it's hard to argue with that. But, and the reason why is, look, we've kind of lost our way in the trade. And that's a big thing to say. But when you have interest rates for 15 years at 0%, and you get these kids coming out of, I was a professor of finance at DePaul University in Chicago. They're graduating in 2008, 2009 during the great financial crisis. And now they're between the age of 36 and 40 at some of these big investment banks. And they're banging on Jay Powell's door saying, hey, 4.5%, 4.25% is way too high. Well, first of all, Fed funds on the average over the last 50 years is around 5% anyway. It's just under that, right? And if you can't make money at that, you need to go back to business school and figure it out. I remember when I got one of my mortgages, I got 7.75%. It was a 30-year low at the time, and I skipped all the way home. Now, I don't know if that's saying I'm old or, it was just that way of the cycle. But when you have outsized returns on the stock market because of a fake low interest rate, you skew everybody's expectation. And it doesn't affect commodities as much. It does a little bit when we talk about carry and all those types of things and storage. It affects it less. But when you've got people that think that you're going to get a 25% return year in and year out on your NASDAQ position, that's insane. And that's part of the factory reset. You have to say, let me go back and look at an S&P 500 chart going back to 1970. It goes from the lower left to the upper right slowly, 8 to 12% until 2008, 2009. And it looks like somebody just said something like, we're not letting the market go down ever again. And it goes straight up. I mean, it's got some gyrations, but that's not real life. And so when we have a large part of the trade expecting a large percentage return, that makes commodities even less sexy. So I think we're going to come back that way when people start to realize that the last 4 years, my equity returns were ridiculously high. And when you start to go say, Deutsche Bank just put out something earlier this year. Hey, let's expect 8 to 12% return on our equity portfolio and have an average 10-year yield of 4.5 to 4.75. Hey, that's fair. Now commodities are in the game. They can compete with that, right?
Right.
But commodities can't compete with a NASDAQ up 28% year over year. It's insane. But I don't know how to tell a kid that's not been in the business that long that that's not real. Because he'll show me the money and say, well, how not real is this money? I've said, all right, it's not sustainable. Maybe I should change my language with you. But at the end of the day, that is not going to last forever. Corn, wheat, beans, cattle, hogs, that's going to last forever. And you know what? You got to eat. I'm going to watch you eat your stock. I want to watch you eat your money, because that isn't going to keep you alive. So I think you can tell I'm excited, because I think there's just so much happening. And if you throw Trump and this administration on top of it, but these baloney returns that some of these New York Wall Streeters think is going to happen forever and ever, it just drives me crazy. That's why I have friends that are stockbrokers, but I'm like, that is the easiest job in the world. Just buy it. It's going up. You might get, you tell me, what commodity could you pay the high of the year every year since 1930 and be a billionaire?
You would not be.
Right. You'd be broke.
Yeah.
But you could pay the high every year since 1929-30 in the stock market and be a billionaire. How hard is it? I know I'm dumbing it down a little bit, but I do it to rile people up a little bit, because I just think that commodities should be more in the spotlight because it's harder to do.
I think, Scott, what it's going to take is, like you mentioned, stock market up 25% last year, 25% the year before. It had this, this gasoline thrown on it constantly with low interest rates. It had the Bernanke put constantly. The market was not going to go down.
That was 2008, the Bernanke put. You're right.
Yeah. And the whole idea behind now Powell doing the same thing, as soon as the stock market falls down, a Fed governor out of Chicago or somewhere comes on and said, well, interest rates could actually come down. And then there's the put that develops yet again. But the stock market up 25% 2 years in a row. Maybe it's single digits this year. And then that might be some of the draw into investments like commodities, because 25%, while that's great, and certainly it is, I'm happy for everyone who participated in that the last 2 years. Maybe we were looking at single digits, and who knows, maybe the stock market might actually go down someday. We'll see.
There'll be a lot of people that are shocked. They bought their money back from university. It's like they believe it's not going to happen. But you're right. And since their Bernanke put was in there, and now everybody kind of follows suit with it. It's like every time we get nervous in the stock market, they're going to cut rates.
Right.
Why? Why can the market not go down? Can you imagine if we had that in corn, wheat, and beans? Can't let the market go down. Kidding me? No, they're out there slashing rates. And the dumb thing about it is that I would get more angry, but except for the fact that they would actually slash rates into a negative. Remember, we talked about negative interest rate policy, not just ZIRP with 0%. We were talking about NIRP, negative interest. There was a time, I think it was in 2020, maybe 2021. I don't know. We had 17 or $18 trillion of bonds around the world priced at a negative. where you gave them your money and you got back less. I mean, that's how insane we got. The only people that made any money on that thing, the biggest trade I saw was, the guys in Ireland. Their central bank said, you know what? Let's see if we can float a 100-year bond at 1% and see if we can get it done. And they
I remember
got it
that.
done.
I remember
So
that.
they borrowed money for 100 years at 1%. Smartest guys on the street. At the time, people thought they were stupid. And look what happened to a lot of our banks here. They were taking in all this customer cash and throwing it in the market at 1.5%, 2%.
Right.
And all of a sudden they realized, I mean, these are bankers. You think that they're supposed to be smart. All of a sudden our 10-year yield goes to 4.5%, 5%. They're underwater on all this stuff. If they get called on it, they're out of business. I mean, it's almost like you can't make it up. But here we are talking about commodities, which is already hard enough with Mother Nature. And number two is, it's the only business that you can actually be a proprietor of. Say you're a farmer and do everything right and be out of business. I mean, to me, that's amazing.
Scott, what's so interesting with interest rates when they were at 1.5% and these banks loaning out, billions and billions of dollars, it goes to 4.5. That's a 3x loss. And I don't
Yes.
think everyone understands that completely. It's really something when interest rates were at that level, which was so dangerous. And it was a sugar high for and I know we had to dig our way out of, the worst dilemma in years in this country. So did it have to, be that way elsewhere? But then it goes, interest rates normalize, and then the massive losses on that. But interest rates, at 4.5 and 5, maybe that's at a level that people can borrow and get mortgages and fund investment and still do quite well
I think it'll take 6 to 7 years of people start to get used to higher rates. We have to get rid of a generation that thinks that everything should be free. Because they're just used to it. I mean, I guess it's not all their fault, but we need to have that work through the system because all these people, I mean, I work with a bunch of them. They're in their 30s. They're waiting for mortgages to get back down to 2.75 to 3%. Well,
Right.
you're going to wait about 5 or 10 years and you're going to finally say, all right, I'll take 8, because it's just not going to happen again. Unless we have some sort of calamity and they manage the government's finances badly. But it's been terribly exciting, and I've been lucky enough to be alive during it. And I also got lucky enough to start off in the commodity sector because I think that's the toughest place to start. And it's been a lot of fun. So, and it's going to continue to be that way with what's going on with our administration here, and then what's going on around the world. I mean, I never thought there's underlying issues with, say, oil and how Saudi Arabia, the U.S., and Russia might somehow get together on some stuff. I mean, there's so much going on when we talk about commodities around the world. And at the end of the day, we all got to eat. But I think that it's probably, it's so underrated right now. And I think that this crowded space obviously is equities. And I think that's so overrated. I think we're in for a lot of fun.
Sweet. Well, let's talk about how we're going to, you mentioned the fact that the summer and that it may have a negative effect on the cows. Let's take the crystal ball out for folks who have not had the 30 years that you and James have had in this. What will that mean if the summer does come to fruition where it's a dry summer and we're not able to produce as much? Can you spell out what the two sort of outcomes would be of that?
Well, if it comes to cattle, I don't think cattle are going to spike higher and run away from you. I mean, there's only, they're not going to grow to the sky, but they're going to stay expensive. And that industry's done really well introducing dairy into the mix. I mean, they're doing whatever they can do. They want to make money too, obviously. But I think a dry summer also would hurt corn. Corn's suddenly gotten a lot tighter than everybody thought it was. We thought we were going to have a huge carryout. That's not the case. So I tell you what, we can't afford to have a dry summer. How about that? I mean, well, no, let me rephrase it. Whatever happens, but that would be bad. We're going to have to afford it. But the problem is we're staring at your costs going up 60% and the price on the board going down 30%. That's a tough scenario to be in. I mean, I just got off a call with a guy talking about cotton. Man, they're having a rough time.
Yes,
Right now it's 68, cents a bale. They need it to be 88 cents a bale to make money. So there needs to be, and to your point, it might take a year or two to come through the system, but we need to recalibrate. There needs to be another factory reset on our commodities because these costs aren't matching what's happening on the big board.
You know, Joe, the dry summer is higher feed costs. You know, a drought is going to diminish the size of the corn crop, so that's more expensive. And then a dry summer also, of course, is less grazing for the cattle to participate in it as well. So just and I heard the same thing, Scott, that you were talking about earlier, was the chances of a dry summer is just, it's like hitting on all five ideas that it will be a dry summer. And that could, you know, certainly create some higher
I mean,
prices later this
the
year.
more I hear about it, the more I think it won't happen, you know, because I'm kind of that way too. Um, but there's too many smart guys thinking these 4 or 5 things are lining up that we haven't seen in a long time. That could make this, you know, a tinderbox. So, you know, then I'm I've got that in the back of my mind. I talk about it when we talk about it on air. And right now the producers in America they're struggling. I mean, they just are. It doesn't have to be corn. A lot of folks across the spectrum, they got used to the $6, $7, $8 corn, right? And like 25% return on your NASDAQ, it doesn't last. So you have to have a decent plan on what to do now when your margins are crushed. But like I said, I love Jim Rogers. I think commodities is the place to be because it's the unsung hero and it's not the sexy place. But you know, you can't eat your stocks, you can't eat your bonds, but you got to eat commodities.
Well, James, I'll give you the final word here. After this conversation, the cow guy spelled out pretty well, but for folks who are not the cow guy, what are some of the big takeaways from today that people get from our conversation?
I think, you know, commodities versus, you know, stock indexes and, you know, the stock market, I think it is a really interesting comparison. Up 25% 2 or 3 years in a row. Perhaps it was on a sugar high with low interest rates and so on. Um, the stock market does trade from left to right, left bottom, top right. It does do that, but it does have, sometimes it does go down. And interestingly, people are understanding that that now can happen. If you bought Nvidia, you know, at the wrong time, you're down 35% in a very short period of time. And people are waking up to the idea that stocks don't go up all of the time. If you look at a 50-year chart that, like Scott just mentioned, it appears to, but there are some down movements in it. And I think commodities could be the benefit. When we talk about commodities to investors, there's a stronger interest for commodities than there were in the past. When the stock market's up 25%, people don't even want to talk about commodities because
Right.
all they can do is look at their stock portfolio. But we're starting to see a lot of cracks in that in Southern Florida right now. A lot of people are looking at alternative investments. So we'll see if this might be the new normal. We'll find out soon.
Awesome. Well, Scott, if you want to keep up with what's going on in your world, where should they start? I know you got the show on RFD, but if folks want to keep track here, where should they go?
I mean, you know, my shows. I put the show out on Twitter. I put it out anywhere else. The RFD TV. We're on at 1 Central, 2 Eastern every day, coast to coast live. And so if you know that's and I like I said, I try to put it on Twitter. Or you can get the our RFD TV Now app. There are any number of ways, but we have because I've done so much TV myself. I'll do a little bit of a plug for it, but I've been on all those shows: CNN, CNBC, Fox, blah 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 blah. And I did it for so long that I was able to pluck the 15 to 20 best guys I knew. And they all said yes to do my show. We're going to try to make it an hour soon here, but we have three new guys on every day. And they're the best in the business. I mean, they always don't get it right, but they'll give you a good reason and why. And it's turned out to be really good. And, you know, we have New York stockbrokers on my show that I think are really bright. Sometimes they're hard to listen to. Sometimes they rub you the wrong way. But they also get a lot of business from these wealthy landowners, farmers, ranchers. They're picking up accounts that they never knew were out there. So it just reinforces the fact that I know that these guys want to hear somebody talk about what they can do with the money they make from their regular day job to make their family, safer and wealthier down the road. So it's been great. It's been very rewarding, and hopefully we keep it going, with hard work.
Awesome. Well, thanks so much for joining us today. We really appreciate it.
Not a problem, guys. Thank you.
Scott, it was truly great talking about commodities with a commodities guy, and I would really enjoy circling back a little bit later this year and see how this all developed.
Yeah, that'd be great. I guarantee you we're going to have tons to talk about. That's one thing I know for sure.
Terrific.